Hello, everyone. My name is Jordan Johnson with Couples Create Cash Flow, where we talk about finances and becoming financially free using very specific strategies like velocity banking strategy, which is what we're going to talk about today. So let's jump into it. Today, I wanted to really just give you an overview of velocity banking basics and get you in at least interested or maybe a little bit more understanding of how it works. So let's begin. First of all, if you like what you hear today, or if you've been kind of browsing around trying to figure out if velocity banking is for you, it can feel kind of complicated and overwhelming to change your financial picture in order to make velocity banking happen. Um, and so I want to try to make it as simple as possible. And so I have a free guide available in the description below with a checklist that helps you to compare HELOCs from different lenders and figure out which one's the best for you. I also have a course that is specifically designed to help you get the right HELOC for velocity banking so that you're set up properly. And that is like a 2.5-hour course, and it's priced at $147. So check out the link in the description below to get to that page as well. So first, I want to define what I say financial freedom is, and it's when your cash flow from your assets exceeds your monthly expenses. Then your income from your job, your active income, is now optional. That makes you financially free. We're all on different stages of our journey to get there. And if you're watching this video, it's because I think you want to get to that place of being financially free. HELOCs and velocity banking are merely a tool to get you from where you are to where you want to be, because it helps you pay off debt and it helps you have money for investing. So what is velocity banking? Essentially, it's an attempt to use a single dollar more than once, and it creates a more efficient personal finance structure. That does not mean that it is simpler. It just means it's more efficient. So if you're using your HELOC and your paychecks are going into your HELOC, and then your HELOC is paying down a debt, and then you're running all your expenses on a credit card, and then your HELOC is paying off your credit card, whenever your paycheck dollars come into your account, it reduces the interest that you're paying on your HELOC. It frees up more money to then use again because it's a revolving account, which then means you could use that same dollar as both a debt reduction tool, or you could then use it as a down payment on a house, like a rental house or something. I mean, you really do have a lot of different ways that you can use those dollars. And then the HELOC itself, depending on your tax situation, you may want to talk to an accountant, can sometimes lead to the interest being a write-off for you. So you do have to consider the fact that the HELOC is, as a tool, it's secured by your house. And so the equity that you built up by making your payments is actually helping you to then move forward with your goal of becoming financially free, because you can pay off your debts faster and you have more capital available to you to invest. And if you haven't read Rich Dad, Poor Dad, I would highly recommend you read that book. That's really the book that taught me about the importance of spending my money to buy cash flowing assets, because that's what gets you to financial freedom the fastest. And the way that you use velocity banking to, set up this structure is to use a line of credit. I recommend a HELOC because HELOCs are a secured loan. They're a secured line that go against the value of your house, which has a lot more stability to it than your income. And so if you were to use a credit card or a personal line of credit instead, you could accomplish the exact same goals. You would just probably have a lower credit limit, and you would also have higher liability. If something were to go wrong, you would probably have to file bankrupt instead of having some of that cushion of your house value wrapped into the deal. You also have kind of the limit of how much equity you have, so you're not going to overspend. Okay, who should use velocity banking? I say anyone who wants to sacrifice a little bit of simplicity in your finances as a trade-off for a faster journey to financial freedom. That's you, right? Because this system is complicated, but it's faster. It's like, that's just the way it works. And I'll probably post a video in the next week or two about the nuts and bolts, the actual nerdy math behind why it's faster. But in general, if you understand that it is faster, you should also understand that it is more complicated. If you have debt to pay off, this is a really good way to do that. If you are using the debt snowball to pay off your debt through the Dave Ramsey model, you would not be open to a HELOC. But if you're willing to think differently about acquiring a financial tool like a HELOC and seeing how to use it properly so that overall the volume of debt that you pay in a year is actually less than if you were to take on the debt snowball. If that's interesting to you, keep watching. I'm actually going to do a video in the next few weeks as well where we look at paying off a home with the HELOC and how those extra payments can really affect your strategy. So who should not use velocity banking? My answer to that question is anyone who spends all their credit limit available. So if you have a credit card with a $10,000 balance, you're constantly bumping up against that limit, probably not a good idea to get a $30,000 HELOC, right? Because then you're probably just going to find other things to buy and it's not going to be good. If you don't have a plan for getting out of debt or investing, I would say it's probably not quite time for you to do velocity banking. And then if you want to buy luxury items that are actually liabilities instead of assets, that could be a problem. And also, if you're not really willing to trade off the simplicity part of how you're doing your finances right now, and you're okay with it taking a little bit longer to get to financial freedom, that's totally fine. The other thing I didn't put on here, but I'd like to add, for velocity banking to work, you must make more money than you spend. Simple as that. Because the whole process is based on whether or not you have money left over. And the more money you have left over at the end of the month, the faster you can use velocity banking. So really, this is empowering you to create as much cash flow in your personal finances as possible. And this is like the backbone of my whole channel because I want couples and individuals to create as much cash flow in their life from their assets, but also to spend less and earn more in their personal finances to create more tools at their disposal to get further in their financial journey and get there faster. The benefits are, I'm just going to go through 3 benefits and 3 risks involved with velocity banking. Number 1, liquidity. If you have like a $10,000 savings account that's really earning you only a couple percent interest, but you have loans out there like a credit card that are costing you 20 to 30% interest, but you're afraid to pay off those credit cards because then you won't have any money left over. This gives you an opportunity to access some of the equity in your home to get caught up on these other debts, and so that your overall interest savings is really helpful for your total picture. It can replace your emergency fund if you want it to. So what's the difference between $20,000 in the bank and a credit limit of $20,000 in a HELOC? Both of those have a buying power of $20,000. The question is, if you had $20,000 in the bank, what is it doing for you there? If you had debts you could pay off or investments you could make that, are being, you aren't able to do that because you're holding on to that cash, a HELOC gives you that ability to dump that money towards something positive and have the ability to spend it if you need to. You are not charged any interest on your HELOC if you don't ever use it, but it's there. You can use it just like a checking account, and it can be that safety net that you need. And then another benefit is that if you're choosing to pay your house off faster than normal, as you do that, you're gaining equity very fast, but then you also don't have liquidity if something were to come up. So you have to have a bunch of money in reserves in case something does come up, which kind of limits how fast you can pay off the house. So if you wanted to pay off the house, if that was your goal, a HELOC actually helps you get there faster and with more security along the way. Another benefit is that the interest only accumulates by a simple interest method, and it's only charged based on what you're actually using, and it's done on a daily basis. So as soon as a paycheck gets deposited into your HELOC, it reduces your interest, right? So every single thing you do each and every day that brings that balance down or keeps that balance low for as long as possible helps you to pay less interest. You have a lot of control about that. And speaking of control, when you have more money available to you, you have a lot more control. You have opportunities that come up that you never thought you would have. Nobody thinks about real estate investing if they don't have any cash. But as soon as you have some cash and you hear someone talk about real estate investing, it makes a lot of sense. You do a little bit of education, you learn how to do it right, and then all of a sudden you see deals pop up left and right, and you're like, wow, I didn't realize these were out there. It's not that they weren't out there, it's that you didn't have the money to do it, so you weren't thinking about it. All right, here's some risks before we wrap up. Sometimes we spend unwisely if we have more liquidity, and that's a problem because if you've been spending a lot of time paying down your mortgage and you have some equity built up, you don't want to just blow it by buying a yacht or a RV that you're not going to use or a pontoon or something that's just kind of collecting dust and causing you to actually pay more to maintain it. Now, if those are things that help you to earn more money to help pay it back, if you have a plan for that, cool. If it's part of your lifestyle and living a joyful lifestyle and really finding meaning in life, great. Nothing wrong with those things. But a lot of times, the ability to spend more money is a human condition. We get greedy and we want more. We just want more, and we're not necessarily happier because of it. And then if you have a HELOC, your unwise purchases can actually hurt you more because they're usually going to be bigger ticket items. Another risk is that velocity banking is complicated. It's very fluid. There's times when things change and there's times when you need to know exactly how to make a payment in the exact right place in order to have the most optimal experience. And that is not something that you can necessarily know in advance. It may be something you have to take take the temperature of your finances like every couple weeks even, and just trying to figure out like, okay, how is this actually working? What's happening here? And make adjustments along the way. It's about fine tuning it. After a while, it gets a lot easier. But to get it set up, to get the HELOC, to get it set up, to do the right things at the right time and have the right principles in place, you do need to have some clear goals and some priorities to follow. And then when your goal is to minimize the balance in your HELOC every day, that can be an added stress. You may always be thinking about, oh, I don't want this bill to hit today because it's going to make me pay more interest. And if that's the case, this is not the thing for you, because really this should be allowing you to have less stress in life, not creating new stresses that you didn't have before. And then decreased equity in the home. So it's kind of without saying, but because it's funded, the HELOC is funded through the equity in your home. When you sell your home, your HELOC gets paid off, which means you don't have as much left over after the sale. So if you have a $300,000 house, your mortgage is at $100,000, and you have a $100,000 HELOC, you only get $100,000 afterwards. I mean, you got to pay your closing costs and all that, but I'm just saying you don't get the difference between your mortgage and the sale price. You have to add your mortgage and your HELOC balance together, and that needs to get paid off before you make any money on the sale. Also, if you do sell your house, you no longer have access to the HELOC, which is not a bad thing because it gets paid off. But it does mean that anytime you sell your house, you're then applying for a new HELOC, which means you need to show income, you need to show credit score, you need to have all this stuff with your banker. And, if you're in the same area, that's not a problem. But if you move out of state, you have to find a new lender and you have to have a new process. So it does disrupt your financial picture. You'll have to be ready to pivot if you feel like you're going to move and sell your home. Okay, so just going to wrap it up with this. We've talked a little bit, tiny bit about velocity banking. There's a lot more to it. The course that I just got done launching, how to get the right HELOC for velocity banking. I do actually spend a bunch of time going through exactly how to search for that HELOC and get the right one. And then at the end, I leave you with, how do you get set up? How do you get set up for velocity banking? Don't quite get into how to do it, but it does give you a little bit of that information. So at least download my free guide about how to do velocity banking. It'll get you started. And then if you want to check out that course, you can look at that link in the description below as well. All right, thanks and enjoy the rest of your week.